Good afternoon, ladies and gentlemen. My name is Michalis, and I'm the market analyst here at HF Markets. And I'd like to welcome everybody to the last webinar of this week. Today, we're going to be looking at earnings season. We're going to be looking at all the companies that have released their earnings. And in addition to this, of course, we're going to do a quick analysis towards the end of the webinar. So the webinar is going to be split up into 3 sections just to give everybody a good overview of what we're going to go through as part of today's webinar. The first section is going to be an introduction. We're going to get to know and understand what exactly earnings season is, what quarterly earnings reports are, how this affects the financial trading markets, etc. So it's going to be a good introduction. We're going to build a good foundation. And then the second section, we will slightly go more advanced. So what we will actually start to do is we'll look at stock ratios. Now, this is something which is related to earnings season and is particularly important when individuals are analyzing stocks, and not just individuals analyzing individual stocks, but it's very important when people are actually comparing maybe 2, 3, 4 or even more stocks, because when you compare stocks using these ratios, and we're going to go through these ratios step by steps, when you get a good understanding of the ratios and you understand how to use them, how to compare stocks using these ratios, then it's at that point that you get a good understanding of what stock is good value for money, what stock may be overbought, some stocks may be undervalued, and so on and so forth. Like I said, to the end of the webinar, we will do a live analysis, largely focusing on technical analysis. So this is what we're going to go through as part of today's webinar. So as I mentioned, very first section, let's very quickly just go through an introduction, and then we'll start looking at more advanced aspects of the market. Now, as part of this first slide, I want everybody to be aware that, of course, here at HF Markets, we are dealing with investments. And as with all investments, of course, there's a risk to the capital that you are investing. Now, this isn't something which is strange. This is the same with all investments. Doesn't matter if you are trading, for example, a currency pair or stock or indices. They are all deemed as investments. So, of course, it's important that we understand this, that we are comfortable with before proceeding to a full investment. Now, of course, these webinars are not here to give financial advice, but of course, we do want to give as much educational material as possible in order for you to be active in the financial trading markets with knowledge, with confidence, and with expertise in exactly knowing how to trade the financial trading markets, and of course, successfully as well. So this is the reasons why we have webinars. Each webinar is based on something completely different. So I'm a market analyst. I've been in the financial trading markets for 10 years. Each webinar will be based on something different. So for example, some webinars may be strategies on how to enter and exit the market. Some webinars may be more advanced analysis, such as order flow analysis. Today's webinar is more for beginner traders, which have very little experience in the financial trading markets, or maybe we've got some individuals. I've already got somebody who's asked a question here, who's already stated that he has never traded before. So even if somebody has never traded before or is new in the market, then of course this is a great webinar, because it's not a webinar aimed at more advanced aspects such as order flow, delta statistics, and so on and so forth. It's a great webinar to get a good understanding on how to trade indices and individual stocks. And in addition to this, also if people want to build a portfolio, then this is a great place to start as well. A bit about my background, because like I said, my name is Michalis. I'm the market analyst here, one of the market analysts here at our head office. But it's also good to know a little bit about the individual in terms of their background. It's not important to today's topics, not important to the way you're trading or for you to become a successful trader, but it is important to know a bit about the individual who's providing you with this information, because there's a lot of educators on YouTube, there's a lot of videos on YouTube and so on and so forth, but a lot of the time they're providing incorrect information. Now, originally I was in London. Originally I was a financial advisor for 4.5 years. It was more than 4 years, but not quite 5 years. Been trading and investing for 10 years. Since moving away from London and the financial advice sector, I have been a market analyst for 6 years. Just over six years, actually. So this is a bit about myself. Like I said, it's not important to today's topic, but I do get a lot of questions about, how do I know this stuff, a bit about my background, how can I be trustworthy, and so on and so forth. And also, if you go to CISEC's website, CISEC is one of our regulators. You can see I am on the list of approved individuals. So if you go to CISEC and you go under approved individuals, you can see that I'm on that list. If somebody wants to do their own research and homework to look that up. So today we're going to be looking at earnings season. And the reason why we're looking at earnings seasons today is because now we're coming towards the end of earnings season. So we had the webinar just before earnings season started, which was the preview. And now we're looking at a review just before the end of the earnings season. We actually had one of the most important reports released early this morning, approximately it was released approximately 12 to 13 hours ago from NVIDIA. We'll speak about that later on as part of today's webinar as well. By the way, ladies and gentlemen, like I say, somebody has asked a question. Just so everybody's aware, you can ask as many questions as you like. There is a section on the GoToWebinar software. You can type in your question, the question comes straight to me, and I will answer the question live as part of the webinar. I can see somebody has asked a question, but I'm not going to answer the question because it's something that's going to be answered in the next 2 slides. But of course, once we go through that slide, if you're still not comfortable or have questions, feel free to mention it again on the questions page, and I will go back and look at that together. So earnings season, what exactly is earnings season? Earnings season, ladies and gentlemen, is normally a period between 6 to 8 weeks. Now, sometimes it can be longer. A lot of the time it is longer. Sometimes it can be shorter, though rarely is. But on average, we're talking about earnings season lasting between 6 to 7 weeks on average. Most of the times it is 6 weeks. And it's a season, ladies and gentlemen. It's a period of 6 weeks where all the most traded companies in the world, so all the companies which are traded on the stock exchange, it's a period of 6 weeks where they release what is known as their quarterly earnings report. So you can see here, I've written that down as well, quarterly earnings report. Now, what exactly is an earnings report? An earnings report, ladies and gentlemen, is very simply their financial statements. And it's not their financial statements for the year, because anybody who's self-employed and has their company, their own company that is, they will probably know that they do their accounts at the end of the year, and they have half-yearly accounts and the finalized audited accounts at the end of the year. With large companies, especially companies traded on the stock exchange, it doesn't work that way. They have to, by law, finalize and release their earnings data, their accounts, every quarter. So this is why it's known as quarterly earnings reports. It happens 4 times a year, and this is why earnings season comes 4 times a year as well. So it's a period of 6 months where all these companies are going to release their quarterly earnings reports. Now, their quarterly earnings reports, I can see some more questions. I will answer these questions, of course, ladies and gentlemen. It's a question from yesterday's webinar. Yes, our dear Andrea was slightly unwell, so it was cancelled. We do apologize for that. We have had 3 webinars this week. The first one did take place on Tuesday. Yesterday was cancelled because she wasn't feeling too well. Today's is, of course, continuing as normal. But Andrea should be back tomorrow, and of course, webinars will continue throughout the rest of this week and next week and so on as normal. Yes. So carrying on, ladies and gentlemen. When we look at earnings reports, because I can see somebody has asked the question, what exactly is in the earning report? And thankfully, somebody's asked that, because I've said it's their accounts, I've said it's their earnings report, but what exactly is in the earnings report? The earning report, ladies and gentlemen, is very similar to an account for those individuals. For those individuals who are self-employed, they will know what are in an account. But for those individuals who have never seen accounts before or read the accounts, it will show their revenue, their turnover, it will show their profits, it will show dividend payments. It shows anything which is information relating to the finances of the company. So it will show anything in terms of how much debt the company has. It will confirm how much shareholders are taking out. It will confirm the salaries which are being paid. It will confirm profits. It will confirm if certain sectors of the company are seeing losses, and so on and so forth. Now, some people may say, okay, yes, it's interesting. I would like to know how much Apple is earning. I would like to know how many iPhones are being sold or iPads are being sold. I want to know what their most popular product is. I want to know if they're earning more than they were previously earning. This is all very interesting information for me individually, but how do I make money off this? How am I supposed to use this information to predetermine how the price of an asset is likely to develop over a certain period of time? So whether you're looking at an asset such as a stock, or even looking at ETFs potentially, or indices, it applies to all equity-based assets. So this is what we're going to be looking at as part of today's webinar, of course. Now, the first thing individuals need to understand is that during earnings season, all stocks will see higher levels of volatility. Now, some people may say, okay, I understand why a stock which is releasing its earnings season, releasing its quarterly earning report today, will see a lot of volatility. So, for example, today, Nvidia released their quarterly earnings report, the last report for 2023. So I understand why Nvidia is seeing a lot of volatility, but why are all stocks, generally speaking, seeing a lot of volatility? So what people need to understand is that the stock market, to a certain extent, is correlated. Why is it correlated? Because, ladies and gentlemen, the stock market and prices of individual stocks depend on investor sentiment and the sentiment investors have towards the stock market. So I'll give you a very good example. Let's say we are in a recession, and because we're in a recession, the stock market is crashing. Every single day it's losing 5%, 5%, 5% every single day consecutively, and we are experiencing a stock market crash. The stock market over the past, let's say, 2 months has declined by 40%. Would you, of course, during this period, the sentiment, investor sentiment towards the stock market is going to be very poor. It's going to be very low. Individuals will have a very low risk profile and a low risk appetite. Now, if we have a company which, even though there's a stock market crash and a recession, actually is doing quite well, they're not seeing lower earnings, their debt isn't increasing, it's a 100% healthy company. Even though there is nothing wrong with that company, nothing there in terms of its finances to indicate that the stock is going to decline, it still may see a decline. Why? Because the stock market is crashing and sentiment towards the stocks is negative. So this is why, ladies and gentlemen, when you see the stock market, you normally will notice that there's days where the stock market is mixed, but when we see clear price movement, it tends to be the strongest price movement, and it tends to be when, of course, most of the stocks, let's say, for example, if we're looking at the NASDAQ, it's made up of 100 stocks. When we're seeing the strongest price movement, normally 70 to 75% of the stocks at least are all increasing in value, or decreasing in value. So this is a clear direction within the market. So we have to take into consideration that even though there is, of course, earnings data which creates more volatility for that stock which is releasing their earnings report, it creates volatility throughout the whole of the stock market. Earnings reports confirms certain factors particularly, but like I said, the actual accounts actually has a lot of information. But the main thing people want to, of course, know, the two most important things will be earnings, revenue, performance per asset or services. It depends on the uniqueness of the company as well. So for example, Netflix, they look at the number of new subscribers and sometimes future projects. So for example, a lot of the time after the release of quarterly earnings reports, actually the company will confirm future projects. So for example, if you go back to the very beginning of 2023, after the quarterly earnings reports, Apple actually released that they're going to release, it was actually released only 2 weeks ago, a new headset, which was a virtual headset. So it's the first of its kind, ladies and gentlemen. So this is the most important information: earnings, revenue, performance per asset or service, and of course, announcements of future projects as well. Occasionally, a member of the board may give a speech as well. So also keep that in mind. That tends to happen a lot. For example, for Alphabet, which owns Google, which owns YouTube and owns other assets as well, other companies and names as well. They're very well known. So after the quarterly earnings reports, they actually have a member of their board speak to the public. Depending on what he's saying, a lot of the time he will give forward guidance on what is likely to take place over the next few quarters, if they believe the company will do well or not. And because of this, ladies and gentlemen, I've got an individual who says he's got no audio. From what I can see, everybody else can hear. If you cannot hear, please exit and re-enter. I'll actually write that for him. Bear with me, ladies and gentlemen. Okay, so I've just sent that. So keep in mind that that can create volatility as well, because of course the earnings data which is released, it could be positive earnings, ladies and gentlemen. So the earnings per share may be higher than expected. Their revenue again may be higher than expected, but we have to also take into consideration it could be higher, but if the director, the CEO or CFO is going to come out after the earnings reports and say, yes, we had a great quarter, but next quarter we don't believe will be so great, then of course shareholders may sell their shares, because that's negative. Of course, he's given a negative output in regards to upcoming months. Investors use data to determine earnings data to determine the risk potential, dividend payments, growth potential, and so on and so forth. So for example, when we look into, I can see that individual who couldn't hear has now re-entered. Just confirm to me if you can indeed actually hear. Just want to make sure everybody can hear okay. So when we're looking at investing in an asset and investing in shares specifically, we have to think and look at ourselves as actual shareholders and investors. So when you're owning a share, when you're buying shares, what you're actually doing is entrusting your capital to a specific company. In a sense, you are making an investment into the company. Now you have to think, am I going to be comfortable investing in company A or in company B? So for example, if company A has high earnings, and the earnings this quarter was higher than the previous quarter, and the earnings were higher than what analysts were expecting, and I'm looking at the risk, and the risk is generally quite low. So for example, they have a very high market share. They also have for example, very low gearing. So for example, low debt. It's generally low risk, and I can see there's growth potential there. So if I'm comparing that to company B, and company B may, for example, their earnings came in as expected, they weren't able to beat expectations. Their earnings were lower than what they were last year. There's a lot of competition in that market. And for example, as well, there is a certain level of debt as well. So there's less potential and there's actually higher risk. For example, that company may not pay me a dividend, whereas the other company does pay me a dividend. So am I going to be more prompted to invest in company A or into company B? Most likely, I will be more interested in company A. So we have to take that into consideration as part of our analysis. And we're only able to do that if we have access to this information. So it's about using this information to determine where a company may be undervalued or overvalued, where there's more risk than what was previously expected in the market, and so on and so forth. Now here, ladies and gentlemen, we're looking at actually the S&P 500, one of the most traded indices, ladies and gentlemen. It's not the oldest index, but it's older than NASDAQ. It is known to be one of the most mitigated in terms of risk, because of course it's got 500 large companies and not from a specific sector. Whereas when we're looking at the NASDAQ, it's only 100 companies and they're all technology related. So here I've got actually lines where I'm actually pinpointing to you the start of earnings season. So for example, here, ladies and gentlemen, we had the start of the earnings season for the excuse me, for the S&P 500. We can see as soon as it started, we saw a slight decline, but since then, a lot of volatility, a lot of demand, ladies and gentlemen. So look at this demand here. Let's get a pen out so everybody can actually see. Bear with me. So look at this price increase, ladies and gentlemen, after the quarterly earnings report season actually started. Very, very strong upward price movement. So ladies and gentlemen, look at the volatility here. If we're comparing it to the volatility of the 3-4 weeks before that, of course there's a lot more volatility since the release of earnings data. Here we've got the previous one before that. At first, we did see quite a strong decline, but after that, again, a very strong upward trend. Here, if we look at the earnings season 12 months ago, very, very strong upward price movement. From the 4 quarterly earnings reports, so earnings season, only one actually triggered the decline, and that was this one here. We originally saw upward price movement, but after that, we did see quite a significant decline. So if we look at earnings season, out of the past 4 earnings season, which is a period of 12 months, 3 out of the 4 actually triggered a higher price. Only the second quarter triggered a lower price, only the second quarter. So 3 out of the 4 actually caused the price of the stock market to increase in value. So stock ratios, ladies and gentlemen, let's start looking at stock ratios. Very, very important. By the way, ladies and gentlemen, if you've got somebody or some people who are interested in trading, but simultaneously they're also interested in actually building a portfolio, this is something which is extremely helpful, because what it actually will do is it will show you which stock, when you're comparing stocks, you may compare, for example, 5 stocks. Okay, so for example, you may be looking to invest in companies which are search engines related to advertising. So for example, you may be looking at Microsoft, Alphabet, Meta, and so on and so forth. All of these stocks are search engines and also related to advertising. And let's say you want to actually compare these 4 or 5 stocks. and see which one has the most potential for you to be more exposed to that stock in terms of your portfolio. A great way is looking at ratios. Now, the most important ratio, ladies and gentlemen, is not actually part of this slide because it's so easy to understand, and I don't want to put too much text onto the screen. And the first ratio, which is extremely important, is known as earnings per share. Now, when we look at earnings per share, it's very simple to understand. The EPS, ladies and gentlemen, earnings per share, is very simply the company earnings, and you're dividing it by the amount of shares within the company. So, for example, if we got company A and here's the company earnings is $100 US, and let's say there is 50 shares available, you're taking 100 and you're dividing them by 50, so the earnings per share is $2. Very simple. Let's look at company B. Company B, for example, has earnings of $500, and he actually has 100. Actually, let's not say 100 stock. Let's say he has 1,000 stocks. Okay. This company, so it's got earnings of $500. Stocks which are available is 1,000. So his earnings per share is 0.50. Okay. So why is the earnings per share important? Because yes, it's giving you the earnings, okay, which is going to affect the demand, but it's also taking into consideration how many stocks there are available within the market, which is the supply. And we have to think about, when we look at the pricing of the assets, it's significantly based on supply and demand as well. So this is why the earnings per share is extremely important, because if we didn't have earnings per share and the only information you had is company A is earning $100 and company B is earning $500, which one do you want to invest in? You're probably going to say company B. Whereas if you look at the earnings per share, it's something that you would think about again. It doesn't necessarily mean you automatically go for company A, but it's not such an easy answer to the question. Why? Because the other company B has a lot of supply within the market. So individuals are easily able to get access to the stock. And because of that, they're most likely not going to be willing to pay as much for it. Whereas company A, even though it's earning less, there's very little supply within the market. So if for whatever reason demand does increase or their profits do increase, then there's going to be very short supply and a lot of demand, and that can create the stock, actually to push the stock significantly higher very quickly. So that's earnings per share, very important. The other thing, ladies and gentlemen, to take into consideration is price to earnings ratio. So this is the first ratio that we're going to look at, which is on our screen. Yes, earnings per share is also a ratio, but this is the first ratio we're going to look at on our screen, and I will explain what the ratio means as well, as in terms of not just how to calculate it, but if it's high or low, is it better or worse? So the price to earnings ratio. Now, if you take the earnings per share and you divide it by the stock price, it will give you the price to earnings ratio. And I'll explain why this is important. Now, if we're going to use Alphabet, which, like I mentioned before, owns a lot of brands, a lot of companies, including YouTube and also Google. If we're going to look at Alphabet, the price of the stock when I did this webinar a couple of days ago was 141. It will be slightly different today, keep that in mind. $141 per share, and the earnings per share annually was $5.80. So this means, ladies and gentlemen, very simply, that price to earnings ratio is just over 24. How am I working that out? I'm taking the price of the stock, so 141, and I'm dividing it by the annual earnings per share, like this. Okay, and that will give me the price to earnings ratio. So keep that in mind. Now, what is important? How do we use this to compare? Actually, on the next slide, we'll compare some of the most traded stocks together. So this is just still the beginner slides, introducing and building a good foundation. Now, most analysts, it's not always the case, but most analysts believe the lower the price to earnings is, the better. And this is a specific reason that they believe that the price of the stock, well, not so much the price, but the earnings of the company is going to significantly improve at some point in the future. Now, when I say some point in the future, I'm not referring to 5 years time, in 10 years time. Unless you're building a portfolio, I'm going to be willing to hold on to the stock for that long. But especially if you're trading, it needs to be imminent. It needs to be within a reasonable amount of time. Now, investors use this ratio, and they believe the lower the ratio is, so for example, for Alphabet is 24.31, the lower it is, ladies and gentlemen, they believe it's better. Now, why is that? Because they believe each stock, each dollar that we are actually earning, this is how much I'm paying for it. This is why they believe the lower, the better. So for example, if I come to you and say to you, give me $20 and I will give you $1 every single month. And then somebody else comes to you and says to you, give me $10 and I will give you $1 every single month. Are you going to go with me, or are you going to go with the second individual? And the same thing is being looked at when we're looking at the price to earnings ratio of the company. So every dollar that I pay for the stock, how much is the company earning? Okay, because if I'm paying less for more, I see it as more beneficial. Okay, so this is why the lower the price to earnings is, the better in terms of the value you're paying for the stock, and of course the risk in relation to the stock and the potential growth in relation to the stock as well. So this is the most important thing that we're going to look at as part of this slide. Earnings per share is extremely important. It's the first thing that everybody always looks at, but the price to earnings ratio is extremely important as well, especially when we're comparing stocks. Now, the second thing is very easy to understand. I'm not going to spend too much time on this, but it is important for anybody to understand this as well. Dividend yield. What is a dividend yield? All companies, I'll take that back. A lot of companies, not all companies, for example, most growth stock companies do not pay dividends, but a lot of companies, most companies do actually pay a dividend. Now, dividend yield is the yield being paid related to the price. So for example, if I'm paying for the stock $100 and the company is going to pay me $1 this year, it means I'm earning a yield, a dividend yield of 1%, because 100 and $1. So I'm being paid 1%. That is the dividend yield. I'll give you an example. This is a real example. This is an example for Starbucks. The Starbucks stocks, again, a couple of days ago was $93. Their dividend that they pay is $2.28, which means that their yield is 2.45. Now, there's a couple of things that we need to take into consideration. If there's no dividend being paid, it probably means that the company believes there's so much demand for their stock, they don't need to pay a dividend. So this is the first thing. The second thing, ladies and gentlemen, is if the company is paying a very, very high dividend, it probably means this is because the company's stock has declined a lot in recent times. So we have to be cautious that a high dividend yield is not always the best. Unless, of course, for example, you've got a high dividend yield because the stock has seen a significant decline over the past years, for example, 50% decline, but you believe now the stock is undervalued, in which case that's a different scenario. So, of course, we take into consideration dividends as well. Ideally, you want a good balance in your portfolio of growth companies, growth stocks, as it's known, which pay no dividends, but there is high potential for growth, but always as well defensive stocks, which do well in adverse markets conditions. And in addition to this, also looking at, for example, stocks which are neither defensive stocks nor growth stocks, and they pay a decent dividend as well. The last thing we'll look at is also something very helpful when comparing. This is the last thing we'll look at, and then we'll move on to the next slide. This is return on equity. How do we work that out? Also, I've got a question here from an individual. I've got two questions actually. So question number one, I'll answer this before we look at the last bullet points, and then we'll start comparing stocks on the next slide actually. So that's going to be very, very interesting. Probably the most important thing most people want to see as part of this webinar, and along with the analysis at the very end as well. So I've got a question here from an individual. Let me just quickly read this. So dividends, once I was deduced, I'm guessing you're trying to say deducted. Once I was deducted the dividend amount on the short position on the IBAX, so long positions on the index, CFD, or stocks, I will also get dividends. Okay, so keep in mind, ladies and gentlemen, bear with me because the window's open and the blind is shuttering. So let me just quickly close the window. Much better. So keep in mind, when you're trading CFDs, depending on the terms and condition, sometimes companies may say that dividends can be deducted if you're, for example, trading short, and added if you're trading long, and so on and so forth. But this isn't always the case. It depends on the broker you are using, and it depends on the terms and conditions. So always ask so you're aware of this. Yes, if you're trading long, it will be added. If you're trading short, it will be deducted. But again, it depends. Each broker will have their own terms and conditions. So the best thing is to ask. Some people prefer for it not to be included in any way, shape, or form, for example. You're just trading price movement, and it's in no way affecting you if you are trading in terms of the broker, in terms of the asset. So again, it depends. Some people prefer it, some people do not prefer it. The best thing to do though is to ask before you actually speculate, because it depends on the terms and conditions. So hopefully that answers the question. Question number two, it's just a comment. So let's move on. Guys, you're welcome, of course. Got a lot of people saying thank you and so on and so forth. Of course, you're welcome. So return on equity. So return on equity is different to price to earnings. Sometimes people get them confused. It's not the same. You're basically taking the company profits, okay, so the earnings, and you're dividing it by the equity. What is exactly the equity? The equity is basically capital which has been invested by shareholders. Now, I've got another question here, actually. Bear with me. I believe that earnings per share is the same as dividends. No, it's not. Earnings per share is not the same as dividends. The dividend is chosen by the company. So the company will say, we're earning X amount. Okay, so we're earning, for example, $1 billion. We will set aside $200 million for shareholders. Okay, so the company will determine how much of the profits to pay to shareholders. Okay, so dividends is not the same as earnings per share. The earnings per share is all of the company earnings divided by the number of shares. Okay, so for example, like I said, if we've got the company earning $100 and there's 100 shares, the earnings per share is $1. But it doesn't mean you're going to be paid $1 dividend. You may not be paid anything at all. The company may say, we're not going to pay any dividends. There's a lot of companies that say that. For example, most of the NASDAQ does not pay dividends, whereas mostly every single stock as part of the Dow Jones and also a lot of the stocks in the S&P 500 do pay a dividend. So keep that in mind. There's a difference between earnings per share and dividend. So company profits and equity. So why is this important? Because it's basically saying this is how much I've given you as shareholders collectively, and this is how much you're earning. Okay, this is why it's important. So again, we use it when we're comparing stocks. And I'll give you a very, very good example. Let's just erase everything on the screen. Let's look at company A. So we've got here company A. Company A, shareholders gave them $100. And from that $100, they're earning $50 each and every year. So their return on equity is actually 50%. Okay, this is the return on equity. We have given you, we have invested $100, and based on what we've given you, you're able to generate $50. And then we look at company number B. Okay, so company B, they're actually earning, sorry, let's say the shareholders have given them $200, okay? And they're earning $150 per year. Their earnings, sorry, their return on equity is going to be 75%. Now, what does this mean, ladies and gentlemen? Because you may just look at earnings and say, one company is earning more than the other, but it's not just about that. Company A may have a lot of money invested into them, and company B may not have as much invested. But if they had more invested, would they be earning more than the other company? And this is where return on equity actually comes in, because you can see here that based on how much is invested, company B is able to earn more. They have a return of equity of 75%, whereas company A only has 50%. So keep that in mind. It shows you which company is able to generate more income from less. Okay, and of course you want to be able to do so. You of course want a company where you're paying less but they're earning more, and you want a company which has less money but is still able to generate more. Okay, so you can see here how I'm getting you to start to think like an institutional trader. Okay, this is also the benefits of having somebody who has a lot of experience in financial advice and so on and so forth, and in large institutions, showing you how large players within the market actually look at the financial trading market, because they're not just going to look at a moving average and say, yes, I'm going to buy or I'm going to sell. They will use this information to determine this is where there is value and this is where there's no longer value, so I'm exiting the market. Okay, so I'm going to actually compare in more than one way, not using every single ratio, because there's approximate, there's actually hundreds and hundreds of different ratios. If we're gonna not look at hundreds and just look at what is mainly used, we have at least 7 mainly used ratios. We've only looked at 4, apologies. Here though, I'm only gonna look at certain factors though. So here we're comparing 6 companies. We've got Apple, we have Microsoft, we have Alphabet, we have Amazon, we have Nvidia, and we have Meta as well. So all of these companies have released their quarterly earnings report. If we look at Nvidia actually released their quarterly earnings report very early this morning, approximately 13-14 hours ago. Now we're going to look at different things. So we're going to compare these 6 companies. They're the 6 most influential companies within the Nasdaq. Keep that in mind. The 6 most influential within the Nasdaq. Now, the first thing I want people to keep into consideration is that when we're looking at Alphabet, Nvidia, and Meta, they have very, very large market shares. Okay, so keep that in mind. We're looking at a company which, if we're looking at their market, so for example, if we're looking at Meta, which is social media, we're looking at social media, Meta has a very large market share. Okay, so if we're looking at how many people are using each platform, most of the chart will be made up of Instagram and Facebook, which is under Meta. Okay, very little will come under Twitter, Snap, and so on and so forth. Okay, so keep in mind these 3 have very high shares of the market. Okay, so this is the first thing I want people to keep into consideration. The next thing, earnings per share. Keep in mind why this is important as well, because yes, it's looking at earnings, and of course, the more a company is earning, the lower the risk and the more potential. But in addition to this, the earnings per share also takes into consideration the supply within the market. So here we've got the earnings per share. Apple is earning at $6.43. Microsoft is earning more than that. It's actually one of the highest earnings per share, ladies and gentlemen, so that's very important. It's actually second highest. Alphabet has a very low earnings per share. That's not a big issue. I'll tell you why that's not a big issue. Amazon has a very, very low earnings per share. Nvidia also has a very, very low earnings per share as well. And Meta has the highest earnings per share. Now, the only thing I will say about Alphabet, which in terms of it's not an issue, that earnings per share is slightly low. It's not the lowest, and it's not low, but if we're comparing these, it's in the middle, should we say, is that you have to take into consideration there's so much demand for Alphabet that actually every few years they split their stock. So they go and say to a shareholder, you have 1 share, but we're going to split your share in 2 and half the price. Doesn't mean you have less, you have the exact same in terms of money value, but it means that the share price is lower and there's more shares available. Why? Because there's so much demand, and I don't want the stock to become so expensive that it's actually gonna lower demand because there's such an expensive stock. So this is why I say it's not such an issue in terms of Alphabet. You shouldn't view it as having a low earnings per share. It's not a low earnings. Now, in the brackets, this is basically showing everybody how much earnings has increased. Now, Alphabet earnings was saved this earnings season. If we look at the previous 3 quarterly earnings reports, they were actually quite poor, especially in the 3rd quarter. The 4th quarter saved them. So their earnings per share increased by more than 9%, which is quite good. Microsoft, ladies and gentlemen, has a very, very high earnings per share, second highest. This is extremely high, but it hasn't really increased. It's only increased by 1%, which is the lowest on the table here. So that's a slight concern. Alphabet, very, very high increase, 27%. That's very, very high. The highest is Amazon, which is, of course, is very, very good news, extremely good news. And that's such a big increase, 1,100% increase in earnings per share. The only thing I will say to dampen that slightly is we have to take into consideration Amazon was earning nothing a couple of years ago. So the earnings is still very, very low. It's just that it has significantly improved. Then we have Nvidia. Nvidia's increase is extremely, extremely high. 55%, very, very high. And actually, the one which is the most competitive and attractive is actually Meta, which has earned, like we can see here, ladies and gentlemen, it has actually increased earnings per share of 73%. That is extremely, extremely high. And their earnings per share is very high as well. So very high earnings per share and very high increase as well. Revenue, we're not going to look at too much. This is a list of everybody's revenue. You can really look at that on your own. Very self-explanatory. Price to earnings. So how much you paying compared to how much the company is earning. This is very, very important, ladies and gentlemen. And if we're going to look at earnings, if we're going to look at price to earnings, the company which has the best and the lowest price to earnings is Alphabet. So you can see here, if we look at Alphabet here and look at earnings per share and the increase, Alphabet is in the middle towards the top. Okay, why? Because in terms of earnings per share, it's in the middle, but the increase is quite high. So it's in the middle towards the top. But if we look at the price to earnings, if we look at the value of what you're paying compared to how much they're earning, it's actually it's got the best one there, the most competitive. So keep that into consideration. The other thing to take into consideration, ladies and gentlemen, is of course Amazon has the highest increase. Keep in mind, earnings per share for Nvidia was released earlier this morning. The earnings per share again beat expectations, and analysts gave very, very high standards on what they believe was going to be released. Why? Because they keep beating again and again expectations because of demand from AI and chips as well. But they were still able to beat expectations. Before the European session opened, their price of their stock increased by more than 9%. At times now, it's increased by more than 13%, ladies and gentlemen, 13%. So a couple of things to note. Alphabet, Nvidia, Meta has very high has very high market share. We have to take into consideration that Meta has very strong increase in earnings and high earnings. The one which has the most competitive price to earnings in terms of its value, basically, is Alphabet, ladies and gentlemen. So a very competitive stock, like we can see here, is Alphabet. Why? Because it's seen a strong increase in earnings. The earnings per share is quite good. Very, very high market share. Revenue, the third highest revenue here, ladies and gentlemen, but the highest price to earnings. Okay, so you can see here exactly how I'm using this to basically determine, ladies and gentlemen, which stock has more potential. Don't want to spend too much time as part of this slide, ladies and gentlemen. Best and worst performance in February 2024. Main thing, ladies and gentlemen, is Nvidia. This I actually wrote before their release yesterday. So keep in mind, overnight, their stock has increased by up to 13%, 9 to 13%. So they are actually soaring, screaming this year, ladies and gentlemen. They've almost increased by 75% in a period of a month and a half. So it's actually absolutely crazy. Second best performer is Netflix. I'm not going to go through all of them. Advanced Micro Devices is also a chips seller as well. This is one of the only competitors for Nvidia. So if you're looking for a cheaper option as well, you can opt for AMD as well. So the advanced micro devices. We're not going to go through all the worst performers. The only thing I will say is the worst performer is definitely Tesla. Very straightforward why it's the worst performer. Because their ratios are very bad. They weren't able to beat expectations. They're under a lot of pressure from other competitors, especially Chinese competitors. The only thing else we will also say as part of this slide is when you're looking to determine how the price is likely to move, you have to look at both fundamentals. So for example, earnings and ratios, that's all fundamental analysis. But also look at technical analysis and also look at order flow analysis. We're not going to mention order flow analysis as part of this slide because part of this webinar because it's more advanced, but I will definitely tell everybody to make a note of it. If you really want to improve your analysis, look at order flow analysis. Just take this phrase, ladies and gentlemen, and type it in on Google. It will be very, very helpful for you. So order flow analysis. Now, if you're building a portfolio, mitigate the risk. Now, of course, you can be higher risk appetite and risk driven and look at more growth stocks. That's absolutely fine. But to a certain level, also include risk management. So there's different categories. There is growth stocks, like I said, which have mainly high potential a lot of the time, more volatility, but they don't pay dividends at all. Then we also have defensive stocks, which tend not to have a lot of price difference and price movement. They do well in adverse market conditions as well, but they pay a high dividend yield. We have value stocks, which is slightly different to growth stocks, and then you also have risk stocks as well. Risk stocks is basically stocks which have very recently released IPOs or is at the IPO stage. In addition to this, we also include in part of that category penny stocks and so on and so forth. Now, ladies and gentlemen, how long have we been speaking? We've been speaking now for 57 minutes. So I apologize, I've been speaking for a very long time. Let's start looking at technical analysis. So this is the same setup that we used last week and a week before. The reason I keep looking at this setup is people keep messaging me and say, please, let's look at that setup again. Let's look at that setup again. It is very helpful. It is one of the easiest setups which helps traders analyze the market. So this is a 2-hour time frame. We're looking at the NASDAQ. Here I've got a 75 bar EMA. So we've got 75 bar exponential moving average. Please ignore my handwriting. I'm writing using a computer mouse. Here we've got a RSI. So RSI, and it's on a 20-day period. Okay. These are the two indicators which I have on my chart. Now, if the price is trading above the 75 bar exponential moving average, it indicates there's buying potential. If it's below, the case there's selling potential. Then we have the RSI. If we're above the 50 and below the 75, we have buy potential. If we're below the 50 and above the 25, we have sell potential. We don't want to be below 25 or above 75. It means it's overpriced or underpriced. So we can see that this has been working very, very well for us, especially, ladies and gentlemen, the first half of the month. We look at the first half of the month, we increased above the 75 bar EMA here on the first of the month, and it continued to increase all the way up to the 13th of the month, ladies and gentlemen. So anybody traded in this area of the market here would have had a massive price movement consecutive day after day after day for almost 2 weeks straight. Okay, just using this setup, you can see how great that setup was. Though, ladies and gentlemen, also we had to take into consideration, we want the RSI to give us the same indication, not conflicting indications. Now, when we get the crossover downwards, then we can take into consideration downward price movement. But we want to be sure it has crossed over downwards. And a lot of people, they'll wait for the crossover downwards, then wait for it to go back to the 75 bar EMA before trading next downward trend. Okay, so that will help to avoid the false breakout if there's a false breakout. But nonetheless, if we look at the volatility, there's more than enough volatility. If anybody did trade here, there's a lot of downward price movement for any short-term trader to trade the downward price movement. Then we've got a crossover upwards. Again, a lot of upward price movement. Then we had the crossover downwards, especially this downward crossover. Very, very strong, and a lot of downward price movement. Here we were moving down in price from the 16th all the way out to yesterday and early this morning actually. So we're talking about almost a whole week of decline. So you can see this setup here is very, very helpful. Now, what is the current indication? The current indication, ladies and gentlemen, is that the price is going to increase. We can see we're trading above the exponential moving average. We can see the candlesticks consecutively are increasing in value. It's not 3 candlesticks increasing, 1 decreasing, 2 increasing, 2 decreasing, 3 increasing, 1 decreasing, and so on and so forth. No, we have 10 candlesticks, all of them are increasing in value. So you can see there are a lot of momentum, and we're also above the 50, the neutral on the RSI. So that is also indicating to us the price is going to increase. The only thing which is a slight concern is currently we're seeing lower lows, and we've also got we've got lower lows and 3 lower highs as well. So that is a concern. The only reason why it may not be such a big concern is because Nvidia released their earnings, and the earnings were so strong, and it really pushed the market sentiment up. And in addition to that, of course, this is a lot of momentum and a very clear direction in the market. Now, if we're going to look at a 5-minute chart, sorry, this is actually not a 5-minute chart, this is a 6-minute chart actually. And here we've got a regression channel. So basically this yellow zone is a trend zone, this is the retracement zone, this is the correction zone. If we drop below that, then that's the danger zone. This means the trend potentially can change direction. If we're above the trend zone, like for example here, okay, and even also earlier today as well. So for example, here, this was an hour ago, we can see here. It indicates strong upward price movement. When we do get a decline, you can see the regression channel is very helpful, because as soon as it goes to the retracement zone, here it went to the retracement zone, here it went to the retracement zone, it's at that point the price just very simply picks itself back upwards. So as long as we're going to remain in the trend zone here, or even better, above the whole regression channel, we have strong indication of upward price movement. I've got another question here. So this is a good question. Does earnings report in any way drive trader sentiment in any other asset of trade other than stocks? Yes, also ETFs and also indices. But if you're saying something which is in no way, shape, or form related to equities, then yes, it does have an effect, but to a lesser extent. So for example, if earnings is very, very high, then of course investor sentiment is going to be high as well, in which case the demand for safe haven assets such as gold and such as the dollar can decline. Whereas if the earnings was extremely poor for all of the most influential companies, then the dollar can rise, gold can rise, and so on and so forth. So hopefully that will answer the question. Here we're looking at the Dow Jones. This is a 5-minute time frame. What we're looking at here, we want to see the stochastic oscillator in the second half of the oscillator here. I've actually not copied the whole screen. If you looked here, if it was above 50, then it would indicate that it is above. Other than that, I've drawn a line here just visually to help you guys. So this is point number one. You want no stochastic oscillator to be quite high. In addition to this, you want the latest crossover to be an upward crossover if you're speculating the price is going to be upward. So for example, here you can see the blue crosses over upwards. Here the blue crosses over upwards. Here the blue crosses over upwards. These are all indications the price is going to increase. You'll notice most of the crossovers are upward crossovers, again because we've got an upward trend here. Downward crossovers is like this, ladies and gentlemen, which can indicate a loss of momentum or a retracement. If we're looking at upward crossovers on moving averages as well, we've got an upward crossover here, we have an upward crossover here, here another upward crossover, here another upward crossover, and here another upward crossover. Now here the price is higher, here we're also higher, so we're in a profit, here we're in a profit, and here we're in a profit as well. So the first 4 trades will be in a profit at the moment. This crossover only just happened, ladies and gentlemen. The fish crossover just only happened, so we don't know the outcome of that just yet. But the first 4 so far definitely in a profit. Potentially may have already hit their take profits as well. The latest crossover, the fifth crossover, it's not in a loss, it's actually in a profit, but just about in a profit because it only crossed over for about 10 minutes before I took the screenshot. And we're looking at the same setup here, ladies and gentlemen, for the Dow Jones 2-hour time frame. Here we've got 75 bar, exponential moving average. Here we've got the RSI. And again, ideally, we want to see where there's clear market direction, like for example here, okay? And during that period, you can see in that period, we're also above here, we're also above the neutral on the RSI. Latest indication, ladies and gentlemen, like the crossovers on the other slide as well. We can see here we're above the 75 bar EMA, and we're above the neutral on the RSI. The other thing is, ideally, we want to cross above this previous resistant level, and this one as well, ideally as well. But other than that, indications are upward indications, okay? And if we go back again, we can also see that the crossovers is not conflicting. The crossovers are also mainly upwards as well. So, ladies and gentlemen, that brings us to the end of today's webinar, because we've been speaking now for 1 hour and 7 minutes. So let's end the webinar. Let's just double check, make sure we've got no questions. I can't see any questions. I will leave the webinar open for 1 minute. If anybody has questions, feel free to ask now. Until somebody asks a question, quick recap. We've looked at the NASDAQ, we've looked at the Dow Jones. Both indications is upward indications. So potentially more upward price movement based on the technical analysis. We compared the stocks based on stock ratios as well and earnings per share. And again, these stock ratios are all taken from the quarterly earnings reports. If we're looking at the ratios and comparing, again, like I mentioned, Meta and Alphabet looked very, very competitive. You of course can look at the recording. I can see somebody's just said, can I look at the comparison on the recording? Yes, of course you can. The recording is available for you. Otherwise, ladies and gentlemen, if we have no other questions, I'll give people a few more seconds. If we have no other questions, we'll end today's webinar. Let's see if there's any other questions. Okay, ladies and gentlemen, I cannot see any more questions, so let's end today's webinar. Trade safe, trade responsibly. Hopefully you found today's webinar informative and educational. In the meantime, we'll see you next week on our next webinars. Goodbye, ladies and gentlemen. Enjoy the rest of your day and take care. Goodbye.